I'm Charlotte McLeod with investingnews.com, and here today with me is Mike Larson, editor-in-chief at MoneyShow. Thank you so much for joining me again. Great to see you.
Glad to be here, Charlotte. How you doing?
Really good. Nice to be speaking with you again. It's been a little while since our last conversation. And the occasion is MoneyShow's Toronto event is approaching pretty quickly, coming up September 8th to 9th. We're going to get into the details there, but I thought first we could set the stage for what's going on in the markets. So I think some group of people are starting to think that it's possible the Federal Reserve might be able to engineer a soft landing in the US. I've been speaking to a lot of people who don't believe that's the case. So wanted to get your take.
Absolutely. That whole soft landing, hard landing, no landing, people have been throwing out all kinds of different scenarios. And as one school of thought has gained traction, whereas others have faded, it's definitely tugged the markets to and fro. I think if you look at where we are now, the Fed is getting the slowdown in employment growth that they're looking for. I mean, the numbers aren't going into the negative or anything. We are seeing reduced rates of monthly job gains in the U.S. We're seeing, signs of things cooling, coming off the boil. I mean, inflation in terms of the CPI year over year peaked out around just over 9% last year. We're closing in on the low threes now. Clearly, the Fed wants that sort of 2%-ish goal ultimately in the long run. But, there's progress, and there's been enough progress that I think they're fairly happy with how things are. We're more at a point where the Fed's going to be kind of tinkering around the edges versus, in my opinion, launching any more, super aggressive rate hikes or pushing rates higher for another year, for example, after all that we've had to date. So long story short, I think the chance of a soft landing have certainly gone up. And I think that's, generally what the market's expecting. So if things, get worse down the road, that would be a negative market surprise.
Okay, tinkering around the edges. I like how you put that. So all eyes definitely are on the Fed. And this week, what people are really focusing on is the Jackson Hole meeting. So I wondered if you could give a high-level overview of what people should be watching there. I think the theme is structural shifts in the global economy.
Yeah, absolutely. I mean, this symposium, we all know it's an annual event, but it gives the Fed and it gives Jay Powell a chance to sort of set the stage, talk, heading into the fall of this year and the September meeting that's coming down the pike. The Fed has an opportunity to either reset market expectations and say, no, we're going to be more aggressive than you're thinking, or basically confirm market expectations, which is, yes, maybe we have one, maybe two more hikes left at the most, but we're probably going to go to the sidelines for a while. So it's going to be really interesting. The timing's very interesting. It's coming, after a big market advance early in the year and then some consolidation in the last few weeks, because I think some people are taking some steps back and a little nervous about what the Fed might say. But ultimately, I think they have to be satisfied with their progress. And it's interesting, heading into the symposium, there was an article from Nick Timiraos in the Wall Street Journal, who's kind of jokingly called the Fed whisperer, that he knows what the Fed's thinking because he gets tipped off, whatever. He wrote a piece today that talked a little bit about, maybe the inflation target could be loosened. Maybe they could, get closer to 3% longer term, or at least be satisfied not pushing aggressively to drive inflation down to 2% via a hard landing. It's kind of interesting timing, and I think that probably leads into the event where the markets are going to say, Jay Powell, he's probably pretty content to move to the sidelines soon, or if not, again, maybe one or two more hikes this year.
Right. And I think it is important to remember. So we are looking forward to that Fed meeting in September and all of the future meetings. We want to see if we get rate hikes, maybe another one or two, as you said there. But even if we have those hikes happening, I think it's important to remember that we have to stay up here for a while. We can't probably just get right back down to where we were. So maybe you can talk a little bit about the trajectory that you see coming there.
Yeah, absolutely. I think you go back 6, 9, 12 months, the markets were kind of expecting a pretty sharp reversal. Yes, the Fed's going to drive interest rates higher, but then they're going to do a kind of a 180 and turn around and start cutting interest rates again. The message out of the Fed in the last few months, and the message I think Wall Street is getting loud and clear, is that that's not necessarily going to be the case. This is more of the Fed may move to the sidelines, but we're not going to see that big pivot, reversal, whatever you want to call it. We're not going to go back to the Fed cutting rates aggressively. A hard landing scenario would certainly change that outlook, but I don't think that's what the markets are expecting. It's not really what I'm expecting, and it certainly isn't what the Fed's expecting. So I think whether you're talking about here in the US or in Canada, for example, the Bank of Canada and what it has to do, I think we're going to be in a higher rate regime for quite some time, where again, you get rates up and then maybe you stop hiking. You're certainly not going back to rate cuts anytime soon.
Okay, thank you for going over that. I think it's good to hear your thoughts there. The other thing that I've seen you speaking and writing about this week is what's going on in the bond market. So, from what I understand, we've got 10-year yields at a 16-year high. And I wondered if you could weigh in on what's going on there, explain it so investors can understand a little bit better.
Sure, a couple of different things are going on there. I think there's some concern in the bond market, or not concern, but appreciation for the fact that the Fed, isn't going to try and drive us into a hard landing recession scenario just to get hit that magic 2% number, next week, next month, or next quarter. The Fed essentially, I think, is probably going to be content taking some time to get that final reduction from 3 to 2, and maybe they sort of have even a slightly higher soft target than 2% in general. So I think the bond market's pricing some of that in. The bond market's also pricing in how the economic news has gotten better, has stabilized basically. So that once you take those hard landing fears off the table, then ultimately it can drive longer rates higher. And we're also seeing a reversal of the yield curve flattening inversion trend. There was a period of time where long yields were well below short-term yields because people were fearing that recession scenario and expecting the Fed to get very, very aggressive even in the rest of this year and next year. Now, as you price that out, that's causing the curve to uninvert. We're still inverted, but less inverted than we were several weeks ago. And I think that's kind of what you'd expect to see towards the end of a Fed cycle. So I think the market is repricing what's going to happen moving forward. It's repricing the risk, or depricing the risk of a hard landing. And that just is helping the curve and bond investors sort of reposition things to an environment where short-term yields ultimately will be lower than long-term yields again. So all that kind of dynamic is at work at the same time. And the end result is that long-term rates stay elevated.
Okay, you're really making it clear, I think, how these elements are all connected. So that's great to understand here. So we've been talking quite heavily about the US. I also want to look at least briefly about China, because I've been seeing this week headlines ranging from mild to more extreme concerns about the country's economy. So what do you make of that? How would you describe what's going on?
Yeah, absolutely. I mean, the Chinese headlines, I think when you look at some of the reasons why the market was in flux and pulling back early in August, some of it clearly stemmed from worries about China's economy, China's credit markets, and China's real estate markets. We know China had a gangbuster real estate and housing market for many years, overinvestment in real estate, a lot of stimulus coming from the federal government there in China, and that's really been drying up. So now you're seeing the Chinese currency decline, you're seeing the Chinese stock market decline, you're seeing some of these sort of opaque credit markets in China, sort of like what we had going on with our mortgages in the U.S. back in the housing crisis, where there was all this sort of esoteric risk in the markets that people didn't really know, it was there until it started to hit the headlines. A lot of that's going on in China, so China is struggling. And I think that's one of the issues that has been, a headwind for economies like Canada's and Canadian markets, because I think some of it is ultimately tied to the question of how much demand is there going to be for commodities, how much Chinese demand for raw materials and other things are going to be out there in the global economy. And if that does continue to weaken, that's an issue for some exporting nations and some nations that are more commodity sensitive. So I think that's one of the reasons you've seen some foreign markets and even Canada's market sort of underperform the U.S. to a degree. And I think that going forward, the one thing we have going for us with the Chinese tensions is that China's financial system financial system is not quite as integrated globally as what you saw here in the US when we had all the mortgage problems and so on. So you're seeing more of the problems, show up in China's domestic market, domestic stocks and things like that, and less so here in the US.
Yeah, I think you're getting toward a question that I did want to bring up, which is, when you see these concerns about China as a North American investor or just a person who's living over here, how much should that really concern you? And again, it does sound like there's some interconnectedness there to consider.
Yeah, it's one of those things that can cause tremors. I don't think it's one of those things that, again, you're going to see this full-on systemic credit crisis type spillover like you saw in the 2005, 2006, 7 and 8 era, where a lot of the U.S. paper, all these bad mortgages and complicated securities and so on were owned and traded by investors all over the world. So you kind of, the contagion effect was a lot more severe. Here in this case, at least for now, and I think probably for the foreseeable future, some of that's going to stay bottled up in China. It will translate into the markets just in terms of lower growth expectations, weaker performance by emerging markets and things like that. So there's not it's not that there's no spillover. I just think it's a little less, great financial crisis style spillover like we had before.
All right. And so all of this is to say there's a lot going on in the world right now. And you've got this event coming up in Toronto pretty soon, September 8th to 9th. I want to ask what themes you're going to be highlighting there. And especially because I'm sure it'll be mostly Canadian investors attending. What are we going to see?
Sure. We when we were kicking around what kind of theme we wanted to go with for this conference, we ultimately settled on 2024 promise and pitfalls. And I think that's a good way of looking at things because there is promise in the market. There are opportunities, but there's clearly a lot of pitfalls out there too, some of which we've already talked about here. So, we're really excited to be bringing together a lot of top Canadian speakers, top Canadian experts. We've got the likes of David Rosenberg and Brian Belsky, Genevieve Roche-Decter, Derek Foster, Lisa Hannum, a lot of different companies, banks, and publications represented. And the idea is, look, we've got this market again that's got promise, but you really need to know where to invest, and how to trade this market if you want to avoid those pitfalls. So we'll be covering the stock market, the economic outlook, interest rates, real estate, a little bit of everything in those 2 days. And hopefully everybody's going to leave this conference with their brains full and their portfolios with some new ideas.
Yeah, I hope so. And so you listed a bunch of great names that people could see if they attend the conference. I love to ask this question when we're talking about events, but anything that people really can't miss that you would point out?
I think the keynotes that we're going to have on Friday morning, back to back to back, there's a lot of great topics that are going to be covered. David's going to be giving his recession roadmap. He's obviously in the more bearish camp. We have a couple other speakers that are kind of wondering out loud, soft landing or hard. They're going to share their opinion on that. Carl Gomez is going to be talking about the outlook for Canadian real estate. I think that's going to be a big one. So there's a nice mix, I think, of speakers that are going to be talking about a few different things, a lot of different topics. But ultimately, the idea is to get people answers, to help them navigate this market because. Again, it's not sort of that straight up into the right market environment. It's not that extremely bullish, no bearish questions out there type of market environment. It's one that's a lot more nuanced. So I think that's one of those things where investors are really looking for guidance and looking for ideas.
Yeah, I think that's definitely true. And so thank you for going over that. I'm going to leave a link to the conference so people can check it out if they want to learn more. And of course, people hopefully will be attending. I want to finish. So, you mentioned people are looking for actionable things that they can do right now. We've talked before about looking at gold, looking at defensive or as you call them, the boring kind of plays. So if you had some advice to leave investors with heading into the end of the year, what would you say?
Sure. It's interesting you bring that up. Because that was sort of my way of thinking about a year and a half ago. And even before that was that be boring was the best investment advice I had. It was a market environment in the second half of 2021 and really most of 2022 where defensive stocks and sectors were outperforming. The economic outlook was a lot more uncertain. Many of the, sort of bubblicious type sectors, profitless IPOs and tech and things like that were falling apart. And it was a very tough market environment. But starting very late last year, and especially as we rolled into early 2023, that environment started to change. We cleansed or cleaned out a lot of the garbage that was in the markets. We priced in, a lot of risk about interest rates, a lot of risk about the economy and so on. So assets, I think, got cheap again, and a lot of the stuff that needed to be cleaned out was cleaned out. So I actually started shifting. I dropped the be boring moniker, and I started telling people at our conferences, be bold instead, get a little more aggressive, move some of that money that was hiding in defensive spots into more aggressive ones. And so far in 2023, that's panned out really nicely. So I don't think nothing's really changed my view. I mean, I think we do want to be more aggressive and opportunistic. I think you do want to be doing more bargain hunting in this market. And especially with this pullback, this sort of seasonal pullback weakness we've gotten in August, and if it heads into September, I think that's going to set us up nicely for an end of the year run. So I'm more optimistic. I'm more, recommending more aggressive, or at least more, again, a more aggressive approach than that be boring one. Definitely shift into more be bold.
Okay, I'm glad I asked. We've gone from boring to bold,
Mhm.
really interesting. And just a quick note on gold, because gold does kind of fall into that defensive basket. So thoughts on gold as it stands.
Sure, I'm still bullish, and I know sometimes I say that I feel kind of like waiting for Godot when it comes to precious metals. I think last year, gold outperformed the stock market in the U.S. pretty substantially, but one of the reasons it didn't do even better was the rampaging U.S. dollar. I mean, when you had the Fed aggressively hiking, suggesting it was going to continue to do that, and so on, you had a very, very aggressive move in the dollar, which sort of harmed all commodities, including gold. That's changed now. We've seen the dollar come off the boil in the last several months. We've seen other global central banks, including, of course, in Canada, hike interest rates and sort of catch up to what the Fed was doing. In that scenario, you don't really have that dollar governor on the gold market anymore. It's sort of like a car. If you have a governor on the engine, no matter how much you try and jam the pedal down, the engine's not going to go that fast. But if you remove that governor, then that allows you to have that upside that, the asset class can really do well. So I'm still bullish on gold. I think if we get past this Fed symposium, we get into sort of this environment where people are really comfortable with understanding the Fed's probably close to being done, that's going to be a pretty significant catalyst for the dollar to fall, the U.S. dollar to fall, and gold prices to rise. So I still remain bullish there, even though, again, it has sort of tried my patience from time to time.
Okay, I think a lot of people would understand that point of view for sure. So we can wrap it up there. Thank you so much for coming on to talk about the markets, about the Toronto Money Show event, and we'll hopefully catch up again quite soon.
Great. Thank you so much for your time.
Great. Once again, I'm Charlotte McLeod with investingnews.com, and this is Mike Larson with Money Show. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.